So, India's largest logistics company, Delhivery Ltd, has just delivered, pun fully intended, its first ever annual profit in FY25, with the net profit coming in at 162 crore rupees. Now, naturally, the market is thrilled. The stock's up 45% in just the last 3 months, and it's looking like a classic turnaround story. But is it really? Because when you roll up the sleeves and dig right into the numbers, you might just find a completely different delivery at your doorstep. Now, turns out, a chunky part of this reported profit, we're talking about 230 crore rupees, didn't exactly come from sharp business moves. It came from a simple accounting switch. They moved from the written down value method to the straight line method for depreciation. It's basically changing how the company calculates how fast its assets are wearing out. And wait, there's something more. Delhivery also booked 442 crore rupees in other income, most of which came from interest on deposits and investment. Now, Delhivery's core logistics operation is still running at a loss. And that means their money worked harder than their trucks. Welcome to Bottom Line by Groww. In today's episode, we are unpacking the story of Delhivery Ltd. Is this a true business turnaround or just a case of accounting magic with some really good timing? What does Delhivery actually do? They offer end-to-end logistics services. Now, think of this as the entire delivery buffet. You've got Express Parcel services, freight solutions, whether you want just a part of the truck or the full truck. You've got warehousing, you've got cross-border shipments, you've got supply chain software. It's the full package, quite literally. Now, amongst these, the Express Parcel service is their superstar. It contributes nearly 60% of the revenue as of FY25. And Part Truckload Services comes in second, bringing in about 21% of their revenue. And their business model, it's deeply integrated but very asset-light. That means that they don't own warehouses or trucks. They prefer to partner, letting somebody else handle all the heavy lifting, and it's totally a slick business move if you ask me. And as of FY25, they had over 41,000 partner agents, and that covered nearly 19,000 pin codes. Let's talk numbers. Now, since their listing in FY22, Delhivery's performance has been a bit of a mixed bag. Now, revenues have grown at 9% CAGR, losses have been narrowing over time, and in FY25, they finally turned profitable. But, and this is a very big but, a large part of this turnaround is thanks to accounting changes and non-operating gains. Their core logistics engine, that's still spluttering. Now, when we zoom into the segments, the Express Parcels business is still the hero. Now, that's bringing in 60% of FY25 revenues and accounting to close to 87% of their EBITDA. But even here, the pressure's on. Now, margins slipped from 18.4% in FY24 to 16.2% in FY25. Now, it's not a free fall, but when your leading segment is losing a bit of shine, it's worth raising at least half an eyebrow. But here's some good news. Now, their Truckload Service business actually impressed. It jumped from 46 crore rupees loss in FY24 to 101 crore rupees EBITDA profit in FY25. Now, that's the kind of an operational mojo that investors simply love to see. There's also one more plus. They are becoming more capital efficient. Now, they've steadily reduced their capex intensity from 9% of the revenue in FY19 to 5.2% in FY25. Now, they're staying asset light, keeping costs lean, and that's the discipline you should be applauding. But just when the story is starting to sound promising, the plot thickens. Now, in FY25, Delhivery acquired Ecom Express for 1,400 crores, and their idea was growth synergies. The reality is that both companies are pretty much serving the same customers. And also, Ecom's parcel volumes are just 40% of deliveries. So they didn't exactly buy like a trove of infra, tech or new capabilities. It's more like buying customers you were anyway trying to serve. And here's also the kicker. More than 150 employees, including senior leaders, left Ecom Express as soon as the Competition Commission of India, that's the CCI, cleared the deal. From a technical chart POV, Delhivery's IPO in May 2022 was followed by a steady downtrend. They've had lower highs and lower lows. And if you look at the Dow theory, the 440 rupees level has now become like a fortress of resistance. Now, until it convincingly gets past that, the long-term investors are, well, unlikely to feel really cozy. And then also comes a big question. Valuation. Now, at 165 times FY25 earnings, Delhivery stock looks expensive. Now, especially when you compare it to their peer Blue Dart Express, which trades at around 60 times. Now, Blue Dart is also scoring better on return ratios like ROE and ROCE, and it generates more free cash flow with a sturdier balance sheet. Now, the only area where Delhivery is pulling ahead is cash flow from operations relative to EBITDA, but frankly, that's not like enough to justify the steep premium. You could argue that Delhivery deserves a premium for being the largest player with scale advantages, But if you look at historical data, stocks that marry strong fundamentals with reasonable valuations tend to go the distance, really. So stories that lean too much on scale and slick narratives, they often struggle to make the final delivery. So what's the investor's takeaway? Now, Delhivery's FY25 profit is marking a milestone, but you need to understand what's really driving it, and that's accounting changes and investment income, and it's not yet the strength of their core operations. Now, their Express Parcel segment, which is their mainstay, that's under pressure. And you stack that against Blue Dart, the stock is looking pricey on nearly every metric out there. But the long-term promise exists. They have scale, solid tech, disciplined asset-light model, but with current valuations and core profitability still being a tad elusive, as an investor, you should be treading carefully. Because when the story sounds fancy and the numbers don't happily play along, you've got to be asking, is this a true narrative or just a very well-packaged turnaround? Well, leave us your thought in the comments and we'd like to know what you're thinking. And for more stories that cut through the noise, subscribe to Bottom Line by Groww, because some profits walk the talk, others just walk the accountants.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.